Morning. My name is Tess Thorman, and I'm a research associate with the Public Policy Institute of California. Welcome to our virtual program featuring the findings from PPIC's latest report, Understanding the Reach of the California Earned Income Tax Credit. The report, technical appendices, policy brief, as well as the slides from today's presentation are all available on our website at ppic.org. This event is supported with funding from the PPIC Corporate Circle and the PPIC Donor Circle. We'd like to thank them for their support. For today's virtual briefing, I'll present the main findings from our report and then answer audience questions. If you have a question, please send it, along with your name and organization, to the email address on the screen, ppiceventquestions@gmail.com. As a reminder, PPIC is a public charity and does not take or support positions on any ballot measure or legislation, nor does it support, endorse, or oppose any political parties or candidates for public office. And now on to the presentation. So safety net programs in California are largely federally funded and designed. However, in recent years, state-funded tax credits have taken on a small but growing role in supporting low-income families in California. And this really began with the California Earned Income Tax Credit, or the CalEITC, which has grown since it was introduced for tax year 2015. So originally, the CalEITC was designed to boost the federal Earned Income Tax Credit for people who claimed that credit but were earning too little to claim its maximum amounts. And since that point, the credit has been expanded in some ways that in some cases have decoupled it a bit from the federal Earned Income Tax Credit. So for example, originally filers could claim CalEITC with incomes up to $15,000. Since then, it's been raised so that you can claim it with up to $30,000 in income. Another major change was the expansion of the credit to people filing with an ITIN who are primarily undocumented residents. And then in the most recent years, the state has also added 2 additional credits to complement CalEITC, both of which are essentially flat dollar value credits of the Young Child Tax Credit, introduced for tax year 2019, which was originally available only to CalEITC eligible claimants with young children under age 6. And then the Foster Youth Tax Credit for tax year 2022 for young adults who are formerly in foster care. Now, despite the fact that the income threshold for claiming CalEITC was raised to $30,000, the credit is still most generous to extremely low income filers, most of whom are not required to file a tax return because their incomes are too low. And so reaching people who are eligible for CalEITC, but not filing and not required to file a tax return is a key challenge for maximizing how effective the credit can be. Another challenge in this area is that relatively little is actually known about the reach of the CalEITC, and in particular, what share of eligible Californians are now claiming the credit, but also whether it's reaching Californians equitably. And the first question, remains in part because of data challenges around knowing how many people are actually eligible for the credit. But there are publicly available zip code level data from the Franchise Tax Board that, in conjunction with data from the American Community Survey, can shed some light on these questions about equity and variation in claiming. And so to that end, in this project, we look at questions of how credit claiming varies across the state and when community demographic characteristics vary. We look at whether credit dollars are distributed proportionate to likely eligible families. And we look at how claiming changes over the course of the year. And in this report, we focus on claims from tax year 2021. So these are CalEITC claims that were made and processed in calendar year 2022. So to give some context on the size of CalEITC, it's a smaller dollar value credit than the federal Earned Income Tax Credit. Californians claimed a total of just over $1 billion, $1.05 billion in CalEITC and the Young Child Tax Credit combined for tax year 2021, compared to the about $6 billion that Californians claim from the federal EITC about each year for the last couple of years. The CalEITC claims were over 3.6 million CalEITC claims compared to about 3.3 million claims of the federal Earned Income Tax Credit. What you'll notice here in the second column is that the Young Child Tax Credit is substantially smaller. There were about 400,000 claims of YCTC for tax year 2021. And then the Foster Youth Tax Credit doesn't quite show up on this chart because 2023 is the first year that people are claiming that credit for tax year 2022. However, it is an even smaller credit. To date, just about 5,000 people have claimed that credit. Another thing that you'll notice from the second column in this table is that in terms of who claims CalEITC, it's primarily filers without qualifying dependents, even though what we can see in the third column is that both CalEITC and the federal credit are substantially more generous to tax filers who do have qualifying children. And this is the case, the large share who don't have qualifying children is really representative of the broader demographics of tax filers in California, that simply most don't have EITC qualifying children. Another kind of result of this distribution is something that we see in the last column in this table, which is that on average, the dollar amount that filers claim from CalEITC is quite small. The average CalEITC claimant for tax year 2021 had $195 from CalEITC, and 3/4 of claimants had CalEITC of less than $200. You'll also notice that those dollar values are substantially higher for the federal credit and for the young child tax credit, about $1,900 for the federal credit and nearly $1,000 for YCTC. This is because both YCTC and the foster youth tax credit are essentially flat dollar value credits of about $1,000. Turning now to the findings from the report. So first, we find that credit claiming of CalEITC really varies across the state. And to measure how claiming varies across the state, we look at the claims ratio, or the number of claims in each zip code for every family in the zip code with an income under $30,000. So these are families that might be eligible for CalEITC. Now, by definition, this is a pretty imprecise way of looking at claiming. We're not looking for a ratio of one claim for every one family with a low income, simply because definitions of income and of family units differ for tax purposes from how they're defined for survey data purposes. But this measure can still be useful for understanding relative differences between communities. What we find from looking at the claims ratio across zip codes is that ratios tend to be lower in the San Joaquin Valley and the state's northern region. They tend to be higher in Orange and San Diego counties and eastern LA counties, but the claims ratio, the differences in the claims ratio don't follow a single pattern statewide. They also vary within urban areas. And so the report includes an interactive map of this ratio that potentially can be useful for organizations that do local or regional level outreach in terms of comparing claiming across small geographic areas. So geographic analysis in the paper looks at these claims ratios without accounting for some of the differences between local communities, like local income levels and how many families have children. And when we do account for these factors that influence eligibility and credit amounts, we find that claims ratios are above the state average when Latino populations are relatively large, and they're below the state average when white populations are relatively large. And what we're looking at in this chart is that distance from the statewide average. So what we can see here is that the claims ratio in a zip code where the share of residents who are white is small relative to in other zip codes would be 15% higher than in the average zip code. And the claims ratio would be about 6% below average in a zip code with a small Latino population. We don't see as much variation in claims ratios for other race ethnic groups because we don't see as much variation in their population shares. And that's kind of what we see on the right side of this chart. So this finding of higher claims ratios when Latino populations are larger is the case despite the fact that ratios are lower when communities have more non-citizens, which is more likely in predominantly Latino communities. And I'll just note that, that could potentially reflect the fact that this was in early years of eligibility for ITIN filers, just the second year in which they could claim CalEITC. So it's possible that this relationship just reflects low awareness of the credit. Now, another way to assess how the credit is being distributed is what we'll call the dollars ratio. And this is comparing the share of the state's CalEITC spending in a zip code to the share of all families with low incomes who live there. So in other words, we would expect that if dollars were distributed evenly, about 1% of families with incomes under $30,000 would live in a zip code that received about 1% of the state's CalEITC dollars, given that they had similar shares of groups like families with children that would see larger dollar values from the credit. And in fact, we do find that dollar values are on average distributed proportionally. We can see that the dollars ratio is similar to the claims ratio in that there are higher ratios where more of the population is Latino, even adjusting for other local demographic and income differences. And in this figure, we're looking at the predicted dollars ratios when shares of the population are small, medium, or large for each group. And what we see is that regardless of whether groups are small, medium, or large, the claims ratio is around 1-to-1. But again, we see in particular that offsetting trend between white and Latino populations. So finally, we find that when we look at change over time, credits are claimed early in high eligibility communities. So why look at this change over time? It tells us something about who has an incentive potentially to file early in the year. It tells us about who might be experiencing delays in filing or barriers to filing a return, or potentially who's responsive to outreach that happens later in tax season. So I'll just note that, of course, there isn't necessarily a right time before tax day to file a return and claim CalEITC. It's also possible, if you don't owe money, to file a tax return through October and claim CalEITC then. We see that overall, 42% of all young child tax credit claims have been processed by the end of February 2022, as had 28% of CalEITC claims. And by April 30th, these claim shares balance out. In the report, this is shared in an interactive map, and there's a pretty clear pattern that's visible. So the 20% of zip codes with the highest share of claims made early are nearly entirely in the Central Valley, in rural Northern California, and in some parts of the Inland Empire, where between 30 and 60% of claims had already been made by the end of February. And these parts of the state also had the highest numbers of claims overall. So holding other factors constant, we find that there is higher early claiming in places where more families have low incomes and more families have children. That is, where more families are likely eligible for the credit and where those who do claim are more likely to get a large credit. This is essentially additional evidence among those who do file, that among people who do file, those who know that they will stand to see a substantial refund will probably file earlier in the year. Finally, although we find slightly higher early claiming when communities are a higher share Latino versus a higher share white, we see less early claiming for communities where a higher share of residents are non-citizens. So in conclusion, in this paper, we find that CalEITC claiming varies across the state, but on average, credit dollars are distributed proportionally. We also find that communities with more Latino members claim CalEITC at higher rates. And this essentially doesn't appear that the credit, to the extent that a small dollar value credit would do this, is exacerbating race ethnic income disparities. Instead, it points to an opportunity to learn from Latino communities about best practices in terms of tax filing and what could potentially be scaled up statewide. We also see that claiming is lower and tends to happen later in the year in communities where more residents are non-citizens. And so this should really warrant some research on the experience of ITIN filers. So it's possible that this reflects, low awareness of the credit in an early year of eligibility for it. But it could also reflect barriers that ITIN filers face to filing a return at all or to filing one early in the year, such as the time that it takes to get an ITIN. On the other hand, it could be that this really reflects successful outreach that happened over the course of the tax season and encouraged ITIN filers to file returns and claims the credit. So regardless, both kind of point to a need to better understand the experience of ITIN filers and what kind of barriers they face to filing returns. Finally, we see some additional evidence from this work that the credits that both CalEITC and YCTC may be an incentive to file early among those who do file. But, as I noted earlier, reaching non-filers remains a key challenge for California. Raising awareness of the credit, specifically raising awareness of potential eligibility among individuals, is a path to reaching this group, but kind of alternative approaches to reaching non-filers would be making it easier to claim the credit or potentially increasing the incentive to claim it by raising the amount of the credit. And if the state were to go that direction, it could be particularly impactful to raise credit values for filers without qualifying dependents, who are the majority of claimants and who are largely not eligible for much other safety net assistance in California. This concludes the presentation, and at this time, we'd like to take questions from the audience. As a reminder, you can submit questions to ppiceventquestions@gmail.com. Let's see, so my first question here is from Alessi in San Francisco, and they ask, how does the CalEITC compare to other state-level EITCs? So 31 other states, I think, offer state earned income tax credits. The real difference is that most of them are very closely tied to the federal credit. So they tend to match the federal credit. So the recipients are all people who do receive the federal EITC, and they get a boost on that from the state credit. California is the only state with this particular design that really targets a much lower income group than the federal EITC. Because it's also tied to the federal EITC, all of these state credits remain similar in that they vary kind of by the presence and the number of qualifying children. And so for the most part, they usually are pretty small for tax filers who don't have qualifying children. And so, you know, there are a couple of other states that have boosted the credit for filers without qualifying children in a way that California perhaps has not to this point. Let's see, my next question is from Sacramento, and this person asks, can you say more about the expansion of CalEITC to I-10 filers in 2021? Why were they excluded at its inception? And are they generally not liable to pay taxes and not eligible for tax credits? Right, so I think that, you know, exclusion of I-10 filers from CalEITC and YCTC at their inception reflects the origin of these credits in the federal earned income tax credit, because I-10 filers are not eligible to claim the federal EITC. And this is a choice by the state legislature in California that kind of tracks alongside other efforts to use state funds to extend safety net programs to undocumented residents. The other part of this question was about tax paying and credit eligibility. So undocumented workers are liable to pay taxes. You know, people who have W-2 can have taxes taken out of their paychecks, and you can file a tax return using an ITIN or individual taxpayer identification number instead of a social security number. ITIN filers can be eligible for many of the same credits as people who file with a social security number. So in addition to CalEITC, YCTC, and the foster youth tax credit in California, you could claim state and federal renters credits, state and federal child and dependent care credits. But, you know, the major exclusion is still the federal earned income tax credit, which you can't claim with an ITIN. And through 2025, adults with ITINs can claim the federal child tax credit only if the qualifying children on their return have social security numbers. So in other words, you know, ITIN filers are liable to pay taxes and do pay taxes. They're eligible for many tax credits, but not some of these major ones, the federal EITC and in part the CTC. Let's see, the next question is also from Sacramento, and this person asks, you find that CalEITC dollars are largely distributed proportionately to the share of low-income families across the state, which seems like good news. Can you say more about what this does and does not tell us about reaching all eligible individuals and families? Yeah, so it's true. The good news is that this tells us that dollars are reaching Californians in a roughly equitable way. What it doesn't tell us is how many eligible Californians or what share of eligible Californians are actually getting CalEITC. So once we account for some of the reasons that zip codes might get different dollar amounts, like higher shares of children, we see that on average, they all see dollars that similarly reflect their low-income populations, but all zip codes could be getting less than they would if there were full take-up. And we think that that is likely the case, that there's not full take-up of the CalEITC based on a real variety of evidence. IRS every year estimates the share of households that are claiming, of eligible households that are claiming the federal EITC, and has California at around 75%. And this is low relative to relative to claiming of the federal EITC in other states. So that's kind of one indication that take-up of CalEITC is probably similar, if not lower. And then there was some research a couple years ago when CalEITC was a little bit smaller, finding that take-up was even lower among likely eligible families receiving CalFresh food assistance. So, the good news from this report is that it seems like the distribution of credits appears equitable, but that doesn't tell us whether it's reaching, all eligible families or enough eligible families. My next question is from Sacramento, and this person asks, how significant is it that California has expanded the YCTC to filers with no earned income, and what challenges does this expansion bring? Yeah, this is a great point. This is one that we don't really delve into in this report because it's largely focused on CalEITC. Again, this kind of reflects the growth of these tax credits out of the federal and then the state earned income tax credit. So the YCTC, when it was introduced for tax year 2019, was only available to CalEITC claimants with young children, which means that you had to have at least $1 of earned income. And then in the most recent tax year for 2022, this changed. You can now claim YCTC without any earned income as long as you would otherwise qualify for CalEITC. What is so significant about this is that conceptually, many pieces of the safety net have been, designed in the last 30 years so that they're tied to employment. And that's part of, how the federal EITC has become such a large source of support for low-income families. And, removing this requirement and allowing people to claim YCTC without earned income is a step in the other direction, kind of decoupling income supports from employment. As far as the scale of the impact of this change in the short term, to date, a really small share of YCTC claimants are filers with zero earned income. It's like about 1%. And this expansion comes with all of the challenges that YCTC and CalEITC already face of how to reach extremely low income Californians through the tax system when they're not required to file a return. And when they can experience the barriers of filing a return, in terms of the challenges of doing so, potentially the cost of seeking help as really prohibitive. So that remains a challenge for this expansion. My next question is from Ruben Sierra from Golden State Opportunity. And they ask, to my knowledge, there's no official state data on the CalEITC participation rates. Do you use the federal EITC participation rate to extrapolate CalEITC participation rate? No, so in this report, we don't try to look at the actual participation rate, but rather to look at variation across the state. I think as I touched on a little bit before, it seems likely that, CalEITC participation probably doesn't exceed what the IRS has estimated for an EITC participation rate. It gives us a sense of potentially where CalEITC participation could fall relative to participation in other states, but we don't use that federal estimate from IRS here to extrapolate to CalEITC participation. It's an interesting idea, and I think one of the challenges of differentiating between CalEITC and federal EITC participation is this target for CalEITC of the really lower income group than the federal credit, and so some of the barriers to participation could be a little bit different between the two groups. My next question is from Eli Byerly-Duke at the Institute on Taxation and Economic Policy in DC. And they ask, what lessons might California's inclusion of ITIN filers have for other states, perhaps either in terms of impact or in specifics of implementation? Yeah, I think that this is a really important question for research to look at in the future on how this inclusion of ITINs has impacted claiming in California and kind of what experiences people have had in filing returns, in particular, because what we're finding in this report is that it seems like claiming is lower in places where there are more non-citizens, and claiming happens a little bit later in the year in terms of when a higher share of residents are non-citizens. So I think this is a really great next step for research that I think we should spend some time trying to understand what the experiences of ITIN filers in these first years have been in California, and that this should have lessons for other states. My next question is from Sacramento, and this person asks, California has launched several guaranteed income pilots. How are CalEITC, YCTC, and the foster youth tax credit similar to and different from guaranteed income? Yeah, young child tax credit and foster youth tax credit, I think, are in particular closer to guaranteed income now that they don't require claimants to have earned income. So kind of a basic principle of guaranteed income is that you continue to receive it regardless of changes in your other resources. Both of them, and the CalEITC as well, are all similar in the sense that a refund from a tax return is delivered as cash. So the other major tenet of guaranteed income is that it's not restricted in use, it's not in kind, so it differs in that way from food assistance or something like subsidized childcare. A major difference between the two, however, is that, as we were kind of discussing, these are not delivered regularly. These are not a steady stream of income. Tax credits are delivered in a lump sum at tax time. And people use those two things pretty differently. They're both really important ways of delivering assistance. But people tend to research from the advanced child tax credit found that, people when they got a lump sum would use it to pay down rent arrears versus when they received the monthly advance amounts that reduced food insufficiency in a way that the lump sum didn't. So, these are two kind of different frames for providing support that are, both valuable, but pretty different. My last question here, I think, is from Janine in Orange County, who asks, are ITIN filers also eligible for the foster youth tax credit? You mentioned that only that around 5,000 claims have been made so far. Is it common for any ITIN filers to claim the foster youth tax credit at all? This is something that I don't have data on, but if you want to follow up with me, I would be happy to look into a little bit more. Yeah, and the last question here is about what kinds of additional research would be especially informative for CalEITC outreach efforts. I've mentioned a couple things in here about trying to better understand the experiences of ITIN filers and of Latino communities in California. I think there's some space here to better understand the ways that the type of assistance that people seek in terms of tax preparation could impact claiming. And then also we talked a little bit about the expansion of YCTC to claimants without any earned income. I think that this is a group that it's really important to follow and understand what their experiences are and potentially what incentives they have to file, and that could potentially inform outreach efforts in the future. So at this time, we've reached the end of our program. I'd like to thank our funders for supporting today's program and all of you for joining us online. If you're pre-registered for this event, later today you'll receive a survey. We would appreciate you taking a couple of minutes to respond and to let us know how we did. Thank you and have a good afternoon.